Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for Pi Day, March 14th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT, and I'm joined by Dean Croak, who's our Principal Industry Analyst. Good morning, Dean.
Okay, good morning. Welcome.
2 questions for you this morning. What's more irrational, the mathematical constant pi or the United States banking system?
Oh, I think the banking system at the moment.
Yeah, that's true. And then also, what's your favorite pie?
Meringue pie. Meringue pie is lemon meringue pie, to be more specific. It was a pie that my mum made on our farm in Australia. Absolutely loved it.
That's my favorite too.
Yeah.
Okay, I'll just go coconut cream then, just to make sure that we didn't compare notes beforehand. But man, lemon meringue with the model and
she used to. It was in the days like in the 60s where she'd put it out on the kitchen window to cool off, and of course our biggest problem was the birds that would want to come in and have a bit of it, and that's of course was very much what you saw in all the cartoons way back then.
Sounds like a scene right out of
the other part of that story is my dad would have the gun out trying to keep the foxes away from our newborn lambs from the kitchen window. It's
like the Sound of Music, but the Australian version. Someone said their favorite is onion and pineapple. I don't know if there's a way to never think about that ever again, but pineapple should never be, as a 3/4 Italian, you should never put pineapple on pizza.
Yeah. Whoa. Gee, we do.
All right.
It's a favorite.
Well, yeah. All right. So we got freight. We're not talking about pie exclusively today. We're talking about freight and banking, apparently. So I'm going to jump right into our market update, the key points of the week, so Dean can get to the market update. Van and spot rates bounced back down a little bit after that end of the month bump. Flatbed, though, still doing decently well. New contract rates about 10% below the rates they're replacing. That's for dry van, about 6% for reefer. Big news seems to be weather on both coasts. Big nor'easter rolling in up in New England. A lot of flooding in California. Delaying produce season. It should, on the other side of it, though, with all the water, be positive for growing. But right now, not so much. And then in other produce regions, we got strawberries up over 50%. And Texas imports up 15% year over year. So with that, I will turn it over to Dean for our market update. Dean?
Yeah, thanks, Ken. Yeah, there was a bit of a blip last week. The end of month shipping surge had load posts up substantially in that prior week, but they dropped back 22% last week, losing most of their gains. It was actually the lowest volume we've seen this year from our dry van load post data set. Volumes are about half what they were a year ago. Capacity loosened, also 9% increase in carrier equipment posts, around 8% higher than this time last year. So the load to truck ratio didn't move down much from 2.83 to 2.03. In refrigerated, volumes cooled off last week significantly. They were down 20% week over week. Again, that was similar to dry van, the lowest weekly load post volume this year. They're about a third of what they were a year ago, and of course bogged down by a lot of the weather impact produce season regions, Florida, California to name two that Ken's already called out, off to a very slow start. We're waiting for some damage assessments to come in from the West Coast to see how much damage has been done to strawberries and lettuce in particular in that Salinas, Fresno area. Produce volumes are down about 21% in the last month and down about 12% year over year. That's putting creating a bit of a drag on some of our spot market volumes. Equipment posts, were up 8% last week. Capacity loosened. Load to truck ratio dropped more significantly than dry van, 4.29 down to 3.17, down about 26%. In flatbed, volumes were flat last week and at the second highest level this year, which was recorded the week prior, so very different to reefer and dry van. Even though volumes were about triple this time last year, they've increased 16% in the last month. So we're still seeing some pretty solid upward activity in the flatbed sector, tracking very closely with 2019, 2020 levels, though. Equipment posts still very high. So as a result of the activity last week, the load to truck ratio decreased from 17.11 to 15.82. As you can see from the chart, also the lowest in 7 years. Having a look at our market condition index, whipping around the markets, top 5 freight producing states, California, Texas, Illinois, New Jersey, and New York. Rates dropped 5 cents a mile last week to an average of $1.83. That's 11 cents per mile higher, though, than the national average. These states typically account for about a quarter of our weekly spot market volume, with spot rates tracking around 10 cents a mile higher than they were in 2019. Only 5 states recorded a gain last week. Arizona, Wyoming, Iowa, and Texas and New York reported a 2 cents per mile gain. Average in those states was also the same as the top 5 states, $1.83 per mile. Having a look at some of the big movers last week, solid gains were reported along the southern border in Laredo. That's the largest commercial truck crossing zone. Rates increased for the 4th week to $1.84, up 1 cent per mile. Last week, 435-mile loads north to Dallas, paying $2.48 from the previous week. That's up 17 cents a mile compared to the February average. It's the highest since September. 1,500-mile hauls west to Ontario at $1.62, also the highest since June, and about 12 cents per mile higher than the prior month. In the largest freight market in the southeast, big distribution market in Atlanta, volumes were down 9% last week. Capacity eased, rates down 4 cents a mile to a market average of $1.67. One of the busier lanes is Elizabeth, New Jersey, out of Atlanta. They were flat at $1.65. Regional loads to Orlando, though, to the south at $2.74 were 7 cents per mile higher than the February average. Having a look at some of our produce markets in the refrigerated category, market condition index shows us that produce season is starting to roll in Florida. Volumes were up 18% last week in the spot market. Line haul rates are climbing following the state's 5 cent per mile increase to $1.48 last week. It's about 50 cents per mile lower than this time last year, though. Solid gains were reported in the strawberry capital in Lakeland. Plant City Strawberry Festival has just ended. Volumes and spot rates were up 13% week over week and 5 cents per mile. The average northbound load for refrigerated out of that market was $1.38. Further south in Florida's largest reefer spot market, Miami volumes were up 23% last week. Capacity was tighter, pushed reefer spot rates up 7 cents a mile to $1.41. Some of the busier lanes, Lakeland to Hunts Point, New York, the largest food distribution market with a history dating back 200 years. Those loads were paying the highest since June at $1.93. Having a look a little bit further west in Houston, a big refrigerated market for DAT spot carriers. Volumes were up 2% week over week, capacity tight. Rates were up 15 cents a mile to $2.12. Some of the regional loans were paying carriers to $3.32 per mile. That was up 38 cents a mile last week, while loads north to Dallas paid an average of $7.32 per load. So a lot of activity coming across the southern border in terms of import produce. McAllen in the Rio Grande Valley, volumes were down by 14% last week, yet capacity was tighter for the 4th week in a row. Rates are up 10 cents a mile last week out of McAllen to $2.34. Again, having a look at one of the major lanes out of McAllen, Hunts Point, New York, was a popular destination. $2.35 per mile. Rates were about 25 cents a mile higher than the February average. Having a look at flatbed, capacity in Texas was pretty flat last week at averaging $2.20 per mile as a state average, but it is the second highest spot rate in 7 years for that state, surpassed only by last year's record high of $2.61. So we're about 41 cents a mile lower than this time last year in Texas, but it is still good compared to prior years. Solid gains were reported along Texas southern border markets, El Paso, Laredo, and McAllen. Volumes increased by 21% last week. Spot rates in Laredo increased by 2 cents a mile to $2.03, while in nearby McAllen, spot rates increased 11 cents per mile to $2.21. Flatbeds from McAllen to Tulsa paid $1.49, up 4 cents a mile in the last 2 weeks, while loads east to Miami were flat at $2.23. Some of the southeast markets showing pretty good gains for carriers. Spot rates in Alabama were up 5 cents a mile last week to $2.58 as an average for all outbound loads. Remember, folks, these are line haul rates excluding fuel. They were boosted by gains in the Mobile market. Rates increased 11 cents per mile there. In Montgomery, load posts were higher last week for loads to McAllen, back to the export market on the border. Line haul rates eased, though, to $1.78 per mile. That's down 3 cents a mile in the last 2 weeks. And in the Dallas-Fort Worth Metroplex, outbound rates were up 5 cents a mile to $2.15 on 15% lower volumes last week. And wrapping up with our West Coast look at flatbed in San Francisco, of course, with some of the atmospheric rivers are pounding that particular market. Flatbed volumes have been growing over the last 6 weeks following last week's 4% increase. Capacity tightened for the first time, though, in a month. Spot rates jumped 24 cents per mile in San Francisco to an average of $1.90. So wrapping up our market update with our year-over-year look at spot rates at $1.72, dry van line haul rates lost the most ground last week, decreasing by just over 3 cents per mile. They've been tracking the closest to 2019 levels for the previous 6 weeks, ending last week at about 12 cents per mile higher than that particular year. Based on the volume of loads moved, the average rate for DAT's top 50 dry van lanes was 21 cents per mile higher, averaging $1.93 per mile last week. That's 21 cents per mile higher than the national average. On our top 100 lanes, I had a look at some of the lanes that were moving up and down. Line haul rates decreased on 70% of the top 100 lanes, increasing on only 11% of the lanes, with the balance remaining neutral. In refrigerated, following the end of month shipping surge the prior week, reefer line haul rates reversed most of the prior week's gains, decreasing by almost 2 cents a mile last week to a national average of 203. Remember, that's excluding fuel. Reefer spot rates are around 31% lower than this time last year. Having a look at our DAT top 70 lanes for loads moved, last week line haul rates decreased on 60% of the lanes, increasing on only 16% of the lanes, with the balance remaining neutral. And wrapping up with flatbed, spot rates continue to increase following last week's penny per mile gain. National average ended last week at $2.17. Flatbed rates are still about 50 cents per mile lower than this time last year, but identical to 2018. So that's it for this week's market update. Remember, you can find out more about what's happening in freight. The long form version of today's market update will be available this evening at dat.com/market update. And with that, it's over to Ken for the short-term forecast.
Thank you much, Dean. All right, so we're going to do short-term forecast. Just to remind everyone about what we're looking at here, we start with dry van. The blue line is the historical 7-day weighted moving average, excluding fuel, very long haul only. So I believe this is 550 and above mileage. And you have 4 forecasts. You have green, which is ratecast. That's what's in all of our products. Red is a short-term forecast, and then yellow and gray are blends of those two in varying amounts in degrees. So what are we looking at here? I will tell you that pessimism is starting to encroach a bit in our primary modeling. Instinctively, I want to believe that produce season is going to provide a bump, and retail shopping and all of that in the spring will elevate rates. The rate cast is becoming less and less optimistic. I think the short-term model has been rather pessimistic for quite a while now. I would tell you, if anything close to this red line materializes, we're going to be looking at some significant impacts to capacity, right? Significant negative impacts. I think the next couple of weeks will be very important to how the rest of the first half of the year shapes up. We're about to round out the first quarter. We should see some boost from end of quarter shipping heading into Q2. But again, we're in a bit of a precarious position, I think, in the market right now as we head into the end of the quarter. Let's move on to reefer. Similar, but a little bit tempered, right? It's kind of hard to deny the underlying seasonality here in refrigerated. It's much more dominated by spring produce shipping. But again, even the short term has it bottoming out compared to dry van. But when you compare that with ratecast, it's also not an overly warm and fuzzy picture heading into early April. It is also important to recognize that these forecasts do only go through first couple weeks of April. So we could just be delaying things. But again, more of a hole to dig out of. Flatbed is the one ray of positivity. If we go to the flatbed one, the 3 short-term and blended forecasts together paint a pretty similar picture, at least through the April Fool's Day, with ratecast being even a little bit more bullish through that period and then tempering back off as we head into early April. Something to keep an eye on, I think, as we get into that very, very start of Q2 period. So that's the forecast as of right now, and then we're going to move to our key question of the week.
Ken, it's interesting when you look at the forecast. It mirrors what Jason Miller's been saying for probably 4 months now, and that is that the fortunes of the truckload carrier sector will be largely driven by the individual commodities that they have exposure to. That's certainly playing out in some of our forecasts. So the question of the week, of course, it's hard to ignore this particular topic, but the question that we're posing this week is, what impact would a potential banking crisis have on the freight industry?
Well, I think it depends. I can maybe kick this off, Dean, and then we can discuss. But I think it really depends on where you are in the industry. If you had your deposits with SVB or one of the payroll processing companies like Ripple that were involved with SVB last week, I think you were very acutely impacted. You may not have been able to make payroll. You may have had to find alternate means to fund payroll. So that's obviously heavy on your mind. And we certainly don't want anyone to not get paid or anything like that. So thankfully, it seems like most of that is getting sorted out either through activity at the board level, the investor level, or government intervention over the weekend to ensure deposits over and above the FDIC limit. But long term, I think the bigger impact is going to be on interest rates. So I think the Fed has been moved from a rock in a hard place to like a flaming rock in a flaming hard place as it pertains to where do they go next with interest rates. You're seeing a lot of activity on different publications around what people think the Fed's going to do. Is this a harbinger that they'll back off the 0.5 percentage point rate increase that they're expected to have coming up as a result of this, or will they continue on their path to attempt to quell inflation? CPI this morning was well within limits of what we expected, but still up 6% year over year. So it's really something, a bit of an unknown has been injected into the market.
One of the things I've read this week, Ken, is that the Fed's aim in reining in inflation was to raise interest rates until, and I'll quote, something breaks. It's kind of I hadn't really paid attention to that expression before, but I wonder, is this the break point that they're looking for? And if not, what's the downside risk of ignoring that if they let interest rates go even higher?
I mean, my opinion, now, mind you, I only have like 1.9 degrees in finance from 2 state institutions, so take it with a grain of salt, is that I think we need to, like, as a culture, as a business culture, need to stop obsessing and fawning over maybe the wrong thing, right? I know it's unglamorous, these mega banks that take in deposits and then do very prudent things with it to generate cash flow and keep investors' money safe. But maybe that's sort of the pat on the back that we should be giving banks, right? So what happened to SVB? They took in a lot of deposits. They invested in a lot of long-term bonds and mortgage-backed securities when interest rates were low. They didn't contemplate a world where interest rates could ever rise. They rose. The bonds were effectively worth fractions of what they purchased them for. And then they had a deposit base of very, very similar makeup. It was a very homogeneous base of deposits, startups, tech folks. So those folks talk. They decided to withdraw all of their money at once. It's not very easy. It's not very easy to unload long-term bonds, especially not at any kind of profit, and especially not when they're not worth anything. So they went insolvent. I mean, how many red flags were completely and totally disobeyed in that short explanation of how I understand this went down?
Yeah. So one of the big impacts, sort of zeroing on the question that strikes me, other than the impact on demand, is the impact on innovation. Because a lot of those companies exposed to SVP, of course, were startup companies in the tech world. We've seen a lot of tech companies come out of there, or certainly backed by companies that were investing in banks like SVP. So I wonder what the impact is on, do we see the growth or the level of investment in digital technology companies, freight tech companies start to slow down significantly now, or continue? I don't have an answer.
I think that's a broader trend, right, Dean? I mean, we used to see a major funding announcement every other day in the freight tech space, and I can't tell you the last one I've seen that made any kind of grand publicity. There's been a slowdown in M&A. Like the TLDR in this entire scenario, to me, is the longer term trend that's come to a head of money went from being very, very cheap to very, very expensive, right? So whereas money was extraordinarily cheap to get funding, Tiger Global was out there writing $10 million checks willy-nilly, to now it's a lot more expensive. And why is that? The only way money becomes more expensive is whenever risk appetite moves the opposite direction, right? So they're demanding more. There's a higher level of rigor around profitability and return on investment. And you can't just go out and make 10 audacious bets hoping that one of them pays off at 1,000x or something, right?
Right. So, Ken, what are the parallel? I mean, my only other time that I've seen anything remotely close to this was 2008. I was working in the safety aspect of predictive modeling and trunking, and 2009 was such an aberration that we had to truncate that year from all of our previous historical data sets because it was such an abnormal year. I recall back in that particular time when the banking system collapsed that we lost about 25% of our capacity in that 2009 calendar year. So you alluded to something a little bit earlier when you started the dry band forecast, the impact on capacity if there was a much bigger fallout from this. That's one of the things that happens to the freight industry is we see capacity shrink fairly dramatically on the downside.
Yeah, I mean, if you show me like a home, like back then, like there were National City Bank in Northeast Ohio and Western Pennsylvania went out, right? I mean, so like the banks that are involved in typical lending activity, like, look, I don't think this is a hot take, but when I think of a lending institution, what I expect them to do is take my deposit and do normal banking things with it. like the word traditional bank in cryptocurrency should be mutually exclusive. Right. I think the bank should take my money and write mortgages and small business and medium and large business loans with it and invest in ways that, and we've done some regulatory things which have said, look, we're going to ease some of the liquidity requirements around these banks. And what happens when you ease, like, do we think that if the government eases liquidity requirements, banks aren't going to then in turn reduce their liquidity? Of course they are, right? The only way banks make money is to do risky things. And I use risk in the finance sense, not risk as in like the nefarious sense. They need you depositing your money with them is a less risky activity than them lending it out on a mortgage. Even a 30-year mortgage to a 800 credit score carries some level of risk, right? And traditionally, banks have made money on the spread between the risk in their lending practices and the risk of their deposit base, right? The left and right side of the balance sheet. It's just we've sort of lost all touch with reality, where the last 20 years of American capitalism has been paved with obsessing and fawning over companies that don't make any money. Right. So, I mean, when that stuff comes home to roost, and then look, I think there's a lot of collateral damage here, right? Even in our space, people we view as competitors were bit by the payroll service they used, putting their deposits with SVB. In my heart, like even as a competitor, I feel for those because like those folks maybe people count on their paychecks, and managers, I believe, act in good faith and want their people to get paid at all costs. And I saw cases where people were going to pay it out of their pocket. And thankfully, their board stepped up or their private investors stepped up. So this is no fun, right? This is not something we want to have to deal with. But to the extent that it becomes systemic, I mean, I don't know.
One of the things you've always said this year, whenever we talk about the upside of this industry, we always caveat it with, barring a cataclysmic event happening. This is very different than the 2008 financial crisis. We've got a lot more safeguards in place, a lot more banking regulation. But we didn't see a big run on banks yesterday. I mean, the government stepped in and seemed to quell a lot of those fears, although stocks took a fairly big hammering in the financial sector. Do you see any parallels between the two? And, we've seen the end of it, or I guess we don't know. We could see more fallout from other banks, but I'm not sure.
Again, I think when you look at like if a major traditional lending institution were to come into an insolvency crisis, I think that would be. I mean, in 2008, you had sort of unprecedented failure and lack of oversight on top of unprecedented failure and lack of like who would have ever guessed that the bond rating agencies were in collusion with the banks to overrate crappy mortgages. I mean, like, I'm not saying we couldn't have another failure like that again. I just don't think it'll be in the same. Like we've checked that one off our list, right? We've that's come off our bingo card where the entire economy collapses because of McMansions and adjustable rate mortgages. I don't know that that's going to be the Could it be cryptocurrency and just insanely loose borrowing standards? Possibly. I don't know. And then SVB ultimately went insolvent because they couldn't raise money. Let's not lose sight of that. They tried to raise last week $2 billion of private capital or public capital, I mean, however they were going to try to raise it. $2 billion of capital and couldn't. So what's that tell you? That's a really good pulse of the market on how investors are feeling about giving $2 billion to a risky lending institution. Right? I mean, a year and a half ago, 2 years ago, that money would have came out like water. $2 billion, no big deal.
Yeah, this is sort of, we could find parallels in almost every part of our industry, whether you're thinking about, I was talking to Chris Henry this morning, he was talking about customers that are, in the trucking industry in general, are looking to downsize their trailer fleets. I think we're seeing an excess of 53-foot intermodal boxes. It's one of these whiplash effects from this incredible period that we experienced during the pandemic, where prices went up, profitability was fairly high, a lot of economic stimulus in the economy, people had a lot of money to invest. And now, of course, we're seeing the back end of that, which is sort of one thing we've seen in our long-term rating, which is the cycles are getting shorter, but the volatility is getting much more extreme on the up and the down. I think I read a report yesterday that said that markets go up by the steps, come down by the elevator, and I can't help but think that that's sort of where we are right now.
Yeah, I mean, the fact that like actual Nobel-winning economists don't know what impact this is going to have on interest rates is, I think, telling. Right? I'm not going to pretend to understand. I've read probably a dozen articles that say interest rates will go down, which I think would be favorable to the industry because it would make it easier to get into a truck, easier on financing, easier on factoring, all of those different parts of our industry. Then I've read other things that said it's going to cause it to go up, right? And I think the real unknown, reading those kind of two ends of the spectrum, is like how much of it's actually going to be fronted by the taxpayer, right? How much of this bailout that we're not calling a bailout, which I think is also very interesting. The financial lexicon seems to grow every time there's a major crisis, right? It's like too big to fail.
Right.
This isn't a bailout. This is a structured resolution by which the government intervenes and all depositors are made whole. It's like, okay, bailout's a much shorter word to describe what happened. But
I was reading something that Chris Jolly wrote this morning, and I think he was sort of saying that the one thing that he was doing at the moment was focusing on the things that he can control. Like, I'm sort of paraphrasing, but he said in times like this, his go-to strategy is focus on less on the externalities and just focus on the things you can control, which I thought was pretty good advice.
Yeah, I think that's always good advice. I mean, regardless, whether it's good times or bad, and that's what I like about Chris, is that he sort of paints it in a way that you can make money in either environment. There's something to be said, though, about sentiment, right? We've all essentially went from not caring about Silicon Valley Bank and Signature Bank to all of a sudden that's all we hear about over the last 4 days. So does that cause your average American to go to an average store and not spend on your average barbecue grill, right? Those are the things that could actually impact our market and the economy as a whole. So sentiment can become contagion. And this is quite literally a bank run, right? This is what happened with SVB is no different than frontier times America, where people stood in line outside of a bank and took out all the deposits.
Right.
That's literally what happened, right? They took out all the deposits, and banks they have a symbiotic balance sheet, right? Where they have deposits on one side, right? They don't have property, plant, and equipment by and large. Sure, they have branch locations, but they have deposits on this side of the balance sheet, and they have investments on this side of the balance sheet. And when someone takes away all of your deposits and you can't easily liquidate your investments, or you liquidate them at a huge loss, you aren't a bank anymore.
Right.
You are what do they call that? A debtor in possession or something like that?
I'm not sure on the term.
Maybe I would have learned that if I went to a private business school. But any questions from our audience that we're seeing?
None that have popped in. Let me just check here. I did have one yesterday on social media asking about the impact of weather on the produce season. I think we kind of covered that a little bit earlier, but I've asked Cody Collar at ANZ Trucking for what his latest assessment is on the Salinas produce season that clearly is going to be impacted. So I think that for that question next week, we'll have a much better answer once we assess the damage of the 2 atmospheric rivers that are pounding the West Coast right now.
Yeah, that's for sure. It'll be interesting to see how it impacts fuel prices too, right? Weather seems to have a inverse relationship with fuel prices, even though we just saw fuel come down another 3.5 cents last week.
Yeah, down to $4.25. Yep.
So that'll be interesting to see if that breaks through that $4 barrier anytime soon.
Yeah, it's brought the fuel surcharge down to 50 cents roughly, 50 cents per mile at the moment, which is, of course, a long way from where we started a year ago when it was, I think it peaked at about 67 cents. So the fuel surcharge is down 17 cents a mile in the space of 12 months. And in kind of a bizarre way, carrier operating costs are actually less this time of the year compared to last year because fuel prices have come down. Of course, the difference is that rates have dropped substantially. So it's had it's had an adverse effect on profitability. Something we're going to cover in a blog post in the next couple of weeks. Maybe we can touch on it in next week's show.
Yeah, I think that would be good. I was just trying to look for a little data point, and I couldn't find. Oh, maybe for another time. All right, plugs, Dean. What do we got going on?
Okay, a bunch of things going on this week. Sales chatter again, Ryan Mohammed and Jeff Dickinson tomorrow. Remember, new time of 11 a.m. Eastern. It'll be day-to-day Wednesday. Landline Now, Wednesday, 7 p.m. Sirius XM. Robert Rouse is on. One of our news shows, Morning Mug Live, is on Thursday, this Thursday, 11:30 a.m. Eastern. We're talking about leveraging transportation data and using data to validate procurement strategies. Remember, in just 16 days, the Mid-America Truck Show is going to be on in Louisville. DAT is sponsoring the Friday night concerts headlined by LV Shane. You can get one of 15,000 tickets at our booth. Make sure you swing by and get those. I'll be there with the Grumpy Pete outside at the Paul K. Young Truck Beauty Competition. So make sure you come by and say good day. And of course, in about 36 days, the TIA Capital Ideas Conference is on in Florida, April 19 through 22. And that brings us sort of the end of the show. Don't forget, go to dat.com/market update. You can download my weekly long form version of today's market update, complete with all the graphs and charts. And with that, it's back to Ken to wrap up the show.
Yeah, the only thing I'll add is we had a customer advisory board meeting last week in Denver. We got to spend time with 12 to 14 of our customers in person and a couple virtually. And other than waiting to get, if anyone got pictures of the license plate of that bus that hit me the night of the hockey game, I think it was an absolutely great event. Nothing's better than spending time with folks in the industry. I learned a ton. And it was really great to get some feedback. So just sending out a very broad thank you to not just the customers that attended, but all of our customers and partners that send us feedback, whether it's in the app, whether it's through email, in person at trade shows, or take the time out of their week to come out and visit us, because we know that we're all very busy. And I'm very grateful and humbled that folks are willing to spend some time with us. So that was absolutely terrific. Yourself included, Dean. Take some time out of your busy schedule to come share your wisdom with the group.
It's great to be there.
But with that, we'll be back next week. We hope everyone has a great week, a safe week with all the weather stuff going on. And hey, maybe today's a good time to go check what your bank's doing out there. See if they're investing in any Dogecoin. Might be prudent. Have a great week, everyone. Bye.